Okay, let's dive in then. Welcome to the deep dive. Today, we're peeling back the layers of what happened in the global markets. It's Wednesday, May 28th, 2025. We've got a stack of financial news, insights, basically a snapshot of the day. And our job really is to cut through all that noise, find the key signals, and, pull out what matters most for you.
Absolutely. And the sources today, they paint a picture that's, well, it's complex, a lot of nuance. There's this definite tension. One source actually put it quite well, calling it a delicate balance,
Hmm.
a balance between optimism from certain sectors doing well and
Yeah.
this caution that's coming from those broader geopolitical uncertainties we keep seeing.
Yeah.
That push and pull, that's really the story of the day, I think.
That tension, you can almost feel it in the numbers sometimes. So when you look at the big picture for today, the overall market feel, what jumps out?
It was definitely a mixed bag globally. You've got those geopolitical issues kind of hanging over things, creating that caution. But here in the US specifically, there was this noticeable wave of optimism.
Hmm.
It was really driven by specific sectors, and it lifted things quite a bit.
And that optimism, it had a clear leader driving it, didn't it?
Oh, absolutely, no question. The technology sector, it was the undeniable powerhouse today, just significantly buoyed by a whole string of strong earnings reports. And not just earnings, but optimistic forward guidance too from several really key players. And that strength wasn't just, contained. It was strong enough to give a real lift to the major indices.
Okay, let's get into those indices then. Because the US markets, they really did seem to lead the gains today.
They did, yeah. The benchmark index, the broad one, it surged over 2%, which is a pretty strong move, right? It reflects some robust investor sentiment.
Yeah.
Maybe digesting some good corporate news or economic data that came out.
And with tech being so strong, I'm guessing the tech heavy index did even better.
You guessed right. It certainly did. That index outperformed, climbing nearly 2.5%. And that's more than just a number. It's a signal. It points to a really strong rally, specifically in those growth tech stocks, which, as you know, people often watch as a kind of barometer for risk appetite for growth expectations down the line.
What about the more traditional side, the industrial stocks?
They were up too, posted significant gains, actually. The industrial average rose by close to 1.8%. So it suggests even the big established blue chip companies were catching some of that positive feeling in the market.
And interestingly, the smaller companies seem to get a nice boost too.
Yes, the small cap index actually outpaced the bigger ones. It was up nearly 2.5% as well, which often highlights confidence in those more domestic focused companies, the ones really sensitive to the U.S. economy's pulse. It kind of suggests that confidence wasn't just stuck with the giants.
Okay, now here's where it gets really interesting for me, something that sources pointed out. Volatility. What happened there?
Yeah, this is fascinating. The VIX, the index measuring market volatility, it fell by nearly 8%. That's a substantial drop for one day. And it strongly points to a decrease in investor fear, uncertainty. But specifically in the near term, when volatility drops like that, it often suggests people are feeling a bit more comfortable about the immediate road ahead.
So that big drop in perceived near-term fear, that could really be underpinning the bullishness we saw in US stocks today.
Precisely. It suggests the market's anticipating a more stable outlook, at least when it comes to, immediate bumps on the road.
All right, let's hop across the Atlantic. How did Europe do?
Europe was generally positive, but definitely more modest than the U.S. gains. The main UK index, it saw a rise, but just shy of 0.7%. Germany's leading index did a bit better, up around 0.8%. Sources were suggesting these gains were probably tied to some okay economic indicators, maybe some specific corporate earnings over there.
And Asia. Was it the same positive story?
Asia was more of a mixed picture, really showed some regional differences looking at the sources. Japan's index had a modest gain. Some reports link that to positive domestic signals. But Hong Kong's main index actually dipped slightly. Analysts were pointing towards those ongoing geopolitical concerns in the region as a possible factor there. And China's main index, it barely moved, showed very little change. It suggests a kind of wait and see approach there, maybe uncertainty about their economy or waiting for policy news.
Okay, so a really dynamic US market led by tech, falling volatility, but a more muted and varied picture elsewhere. Regional factors playing a big role. Beyond the earnings, what were the other big external forces shaping the day?
Well, geopolitical developments are still weaving this complex narrative in the background, that's for sure. Tensions, in various hotspots. They're definitely injecting that caution we talked about. It contributes to the swings in investor sentiment, keeps people a bit on edge.
And that caution definitely seemed to spill over into commodities, right?
It did. Yeah, commodities markets showed noticeable volatility. Energy, in particular. Prices swung around as traders reacted to news, potential supply disruptions, maybe policy shifts in key producing areas. That whole sector is just super sensitive to the geopolitical climate.
How about currencies? What was driving them?
Currency movements seemed largely driven by central bank communications. What are they saying? What are they hinting at? And also, how are these international events perceived to impact different economies? So some currencies got stronger, maybe seen as having more resilient economies or clearer policy signals. Others faced downward pressure because of the broader uncertainty, maybe some risk aversion. Market participants are definitely watching the major central banks very closely, looking for any hints of policy changes, especially with what's happening in the bond market.
Okay, let's go there now. Let's take that deep dive into the bond market because the sources really highlighted some pretty significant downward moves in yields. What story are the bonds telling us?
Right. And this is where we see potentially a different narrative, maybe a conflicting one, compared to the stock market's enthusiasm today. The overall trend, yields moving down, it suggests a bit of a pivot. Investors may be becoming increasingly cautious about the future economic environment. The bond market is often seen as that critical barometer for longer-term expectations.
Give us the specifics. The 10-year Treasury yield, for instance, that's the benchmark.
Yeah, it declined to 4.434%. That's a drop of about 1.66%. Significant. This kind of drop suggests a real shift in sentiment, probably driven by changing expectations around, say, future inflation or maybe where interest rates are headed. When yields fall like this, it means demand for those safer long-term securities is up. Investors are putting money into bonds, pushing prices up, yields down. It suggests they're looking for stability, maybe seeing some uncertainty down the road.
What about the very short end, the 3-month T-bill?
That yield also dipped. It fell to 4.203%. That's a reduction of about 0.64%. So less dramatic than the 10-year, but it still indicates some adjustment in short-term expectations. Could be reflecting anticipation of maybe potential Fed action soon, or just a short-term risk adjustment based on news.
And the long bond, the 30-year, that seemed to have the biggest move of all.
It did, yeah. The 30-year yield had the steepest drop. It fell to 4.94%. That's down around 1.81%. And that's particularly telling. A big move like that highlights a real reassessment of long-term economic prospects, like looking at decades. Often, a falling 30-year yield signals forecast for lower inflation way down the line, or maybe a slower economic growth path long-term.
So it's fascinating. While stocks and volatility are suggesting confidence, at least for now, the bond market, especially the long end, seems to be flashing more caution about the more distant future, like different time horizons talking.
Exactly. It's like two different signals being sent.
Yeah.
And these yield adjustments, as you know, they don't just stay in the bond market, they ripple out. They influence mortgage rates, corporate borrowing costs, big investment decisions. The whole financial ecosystem feels it.
Okay, let's try and bring this all together for you, our listener. You've got this mix: clear tech optimism, falling volatility in the US, mixed results globally, and then this really notable drop in bond yields. What does this all mean for understanding this market moment right now? How do we sort of square the story from stocks with the story from bonds?
Yeah, that's the core tension, isn't it? The one
Yeah.
the sources really picked up on. The equity market, especially U.S. tech, it's showing a strong appetite for growth, less near-term fear. That volatility drop really underscores that. Confidence in current conditions, maybe the immediate future. But the bond market, particularly that sharp fall in long-term yields, it's whispering a different story. A story of increasing caution about the economic future, maybe anticipating lower inflation or slower growth, potentially years out.
It really is that delicate balance in action, like that source said. Optimism driven by what's happening right now, specific sector strength, but also this caution creeping in when you look longer term through the bond market lens or think about geopolitics.
Exactly, and the sources are pretty clear. The market is now really keyed into upcoming economic data. What will that show? And of course, any big geopolitical shifts. Those are seen as the next potential catalyst. They could either reinforce one of these narratives, stocks or bonds, or maybe shift the balance again.
Absolutely. We'll definitely be watching those closely. So, to wrap up this deep dive, today was really defined by that interesting push and pull. You had strong sector optimism, mostly tech, pushing stocks up, volatility down, suggests confidence right here, right now. But lurking underneath, you had geopolitical factors adding caution. And critically, bond yields fell significantly, especially long-term ones, painting a more cautious picture about the road ahead.
It's a fascinating dichotomy to watch unfold.
It really is. And here's a final thought, something provocative for you to consider as you watch things develop. Given that strong tech performance and the lower volatility suggesting less near term fear, what does that significant drop in longer term bond yields tell us? Where might the smart money really see the economy heading further down the road? Something for you to chew on.